Welcome to this week's version of Nickels and Dimes, our weekly video series. But one of the questions we often get is where will the market find a bottom? We get questions from current clients, prospective clients, casual friends, often ask us how much more downside is there? So I thought what we do today is talk a little bit about a metric that has a pretty good track record to give us an idea of what potentially may be in store for the near future for the equity markets to address something that you may be thinking about. And again, a question that we often get. Where is the bottom? Now, certainly it's anyone's educated guess. We're going to talk a little bit today about a metric that may give you some clarity. So let's dive in. So just some perspective, though. As of last week, here's where we're on the major indices: Dow, NASDAQ, and S&P year to date. And I don't have to tell you, it's been quite a bloodbath. And really, there's no place to hide, as you know. For example, like the long Treasury bond is down over 20%. I mean, even if you have what would be traditionally a safe haven investment like gold, theoretically, basically it's a risk-off trade, and there's really no place to hide unless you're in treasuries or the money market. Well, this indicator, is very, very effective. And as you likely know, Wall Street professionals and retail investors use various metrics, indicators, and economic data points to determine where the stock market will potentially head next. Now, there is a bear market indicator that has a solid track record, as I noted earlier, of calling market bottoms. And it's indicating, and here's what is cautionary concerning, that there may be substantial downside still yet to come in the Dow, S&P, and NASDAQ. Now, I don't share this information with you to scare you, to make you more nervous. The goal here is to educate you so you can make an informed decision. Because, for example, maybe you have cash that you'd like to put to work, and it's now a good time to invest. Where we theoretically have some discounted prices, or maybe you still want to be patient because there's more room on the downside, or maybe just to have some perspective of where we are in the market cycle. Now, the reality is bear markets tend to surprise on the downside. In other words, you're down maybe 15, 20, 30, or even 40+%, and you may be thinking, well, the worst is probably behind us, and actually we end up getting more downside. We saw that, in the dot-com bust that lasted a number of years, obviously the financial crisis. So, again, the goal here is to educate you, to give you an idea of where we are. And this is a metric that, may be able to help you. So what metric am I talking about? This is the S&P Shiller price to earnings ratio, what's also known as the CAPE ratio. You may or may not have heard of it. So the Shiller PE ratio is of approximately 22. Keep that number in mind, is historically where bear market bottoms find their support. In other words, they start, sort of finding, the market starts stabilizing. So here is some more recent bear markets. So for example, the coronavirus crash that we saw from February to March of 2020 showed this Shiller PE ratio plummet from around 34 to 22. And again, during the dot-com bubble, the Shiller PE ratio was effectively halved from 44 to 22. So you may be wondering, okay, well, where are we now in the cycle? And right now, this S&P 500 Shiller CAPE ratio is around a 28. So keep that number in mind. So again, at least in the last two bear markets, that number needed to get to around a 22. We're at let's call it a 28, 29. So if we get down to a 22, where would the S&P actually have to be? Meaning, how much more downside is there if we ultimately end up getting to a 22, again from a 28, 29? The reality is that as of most recently, and really the week ending October 5th, an additional 22% drop plus or minus would be necessary on the S&P to bring it at the same level where support is found if we're comparing it again to the previous two bear market cycles. So again, this would imply that the S&P really drops by around 800 plus points to a level of around 2,900. I know I'm throwing a lot of numbers at you. Hopefully you're following. But the bottom line is, from peak to trough, that would indicate a decline of around 39%. I know for most that is potentially scary, concerning. Again, the goal here is to inform you, to give you a better idea of where we are in the cycle. So there is a real chance, at least if we're looking at the history of the last two bear markets, that there's more downside to come. Let's hope this is not the case. But think about where we are, and we're in a very unusual time where we have high inflation that the Fed is attempting to tame by raising interest rates, but we also have a contracting economy when the Fed is also increasing rates. So usually when the economy is contracting, the Fed is lowering rates. So now we have the total opposite, where we have, we're in a bear market, primarily initiated by, Fed increasing rates, and we have a slowing economy. Fundamentally, that's not a good equation, and it's our position, frankly, until the Fed reverses course, that odds favor there is more downside, and we've kind of noted this in some recent video. Hopefully you have been, paying attention. So again, I want to show you, we mentioned this, a few minutes ago. So we're at a 28.29 on this S&P 500 Shiller Cape ratio, and we need theoretically to get to around a 22 as an indicator. Again, there's no guarantee we're going to get there. Hopefully the market, stabilizes now and we find some support. The Fed, they have a meeting coming up, in the near future. We actually today, as I'm recording this video, an inflation number came out at around 8.2. The market initially did not like it, sold off, and actually we got a big reversal as of the time of this recording. We're up around 700-800 points in the Dow. Again, that's just a one day. And by the way, I should note, most one-day rallies, typically the largest one-day rallies in the Dow on a point basis are in bear markets. So I would say, don't get too excited about this at least this one-day move if you're watching the markets today. So again, a challenging time that could potentially get worse. This is a very credible ratio, so it's something again to pay attention to. So all that is to say is, if you would like a second opinion on your portfolio or financial situation, certainly you can go on our website at nicholswealth.com, and in the upper right-hand tab, you click on this Contact Us tab, fill out the information, and one of our advisors will reach out to you, answer your questions, and hopefully give you some clarity. Thanks again for watching. Bye-bye.